So maybe Crocs are not the sexiest footwear out there, but Crocs stock is a different story, down over 40% year to date. I think you guys gonna be very, very impressed. Now the stock is really going down for no main reason. It has sound fundamentals, it has everything. And I've been trying to find out why the stock has been going down so much. Now, if you look at the 5 year chart, the stock is up above 1,000%. 1,000% for a shoe company or footwear or whatever. It's not a tech company or anything. Now, the main reason the stock went up so much is because sales went up so much in 2021. You can see the sales from 2020 to 2021. It absolutely skyrocketed for Crocs. Why? Because the management, they did a lot of smart advertising, which landed them much more sales than usual. For example, they did some kind of filter on Snapchat. It's called, like the Crocs filter. This is something I would never really put on my face, but this is, what people like, They said over 4 million people use those Snapchats kind of Crocs lens in the first 10 days. A lot of them went and bought Crocs. They did something else on TikTok. It's like you could do some kind of filter on TikTok, and it says globally this drove over 8 billion views and over 1 million uses of the hashtag. A lot of people know Crocs. They know the brand. They know everything. But, Crocs didn't really leverage up the brand very well. But now they're doing something totally, totally different. And they have the money, the cash flow, and the cash to do their expansion. This is one of the first reasons maybe the stock went down, because maybe big funds, they're saying that after those advertising is over, the sales are going to go back down to what they were, and the stock is going to go back down to pre-pandemic, which was, I believe, like $35, $40, and now the stock is sitting around $79 a share. And many of you saying that nobody wants to buy Crocs anymore, but it's not the truth. In Asia, especially in China, it's pretty popular for Crocs. Crocs is also trying to get into other markets, like they're doing Crocs sandals and stuff. And they say they can 4x their sandals revenue by 2026. This is pretty ambitious goals. And they also grew that kind of sandals revenue over 30% in 2021. So you could clearly see that people want to buy Crocs. But Crocs is now expanding through an acquisition of something called Hey Dude. Maybe you've heard of those shoes, Hey Dude. I personally never heard of them until I was kind of researching Crocs and stuff. But nonetheless, they're pretty popular shoes. I mean, if you go on Instagram, on Amazon, 48,000 reviews, 72,000 reviews, 13,000, 72,000, 48,000. This is massive, massive reviews. Some of them are, bestsellers with over 100,000 reviews. So a lot of people do know the Hey Dude brand, and many kind of them really like the brand. And you could see the brand awareness over here. How much is it going up? And the main reason maybe also the stock was going down is because maybe the big funds, they did not like this acquisition because it's different from Crocs, and maybe they believe that kind of Crocs cannot integrate it well into them. But this is not the truth. First, Crocs is an international brand. This is 95% of revenues are only from the United States. So with Crocs, they can expand them through their omni channels all around the world, and they can kind of bring even more brand awareness, even more sales for Hey Dude alone. Now the kind of the acquisition wasn't like a lot of share dilutions or anything. They paid around $2 billion in term loan, 450 million in Crocs shares, and then around 50 million in cash. I don't think they overpaid over 15 times EBITDA because the brand is growing very, very much. Now let me get into my favorite thing, which is the fundamentals of Crocs. Let's compare it to other kind of players in the industry like Skechers, like Nike, like Dexter's, and kind of other kind of brands. Let's look at the profit margin, for example. 49% for this player, around 46%. Crocs is 61%. Okay, but this is not all. Look at net income margin for Skechers. This is around 11.5%. Nike is 13%. 13% for Nike, although Nike is more of a premium brand, which should command much more net income and stuff. Crocs is 31%. 31% net income margin is blowing these guys out of the water. Crazy. Look at their free cash flow margin. Nike's free cash flow margin is 10.10%. Look at Crocs, 17% free cash flow margin. I mean, can you believe that? Now you may say that, yeah, maybe Crocs is trading at a very high valuation compared to these other players. Why? Because they have higher margins and better fundamentals. But no, if you compare them for a basic PE, Skechers is trading around a 10 PE, Nike is trading at a 37 PE, and Crocs is trading at a 7 PE. 7 PE for Crocs. Can you believe that? I mean, this is why I went over and over and over again to make sure I'm not making any mistake. Like, is there anything wrong? I'm not saying, why is the stock going down? down. And I'm not really finding any kind of sane reason why the stock has been going down with such good fundamentals. Look at the price to free cash flow, 14 for this company. Nike is 31, Crocs is 8.5. Now you may say, yes, there has to be something, there has to be share dilution or something. Well, no. Actually, Crocs has been a net purchaser of its own shares, and now Crocs has the lowest share outstanding in the history of the company. Massive share buyback program from the company, but now they halted it, which I liked, because they're gonna wanna pay back the debt down, which they can accumulate from the Hey Dude acquisition. Now, if you look at their balance sheet, you know, their total assets are still, current assets are still higher than their current liabilities, but now they have over 771 million in long-term borrowing, and this does not include the Hey Dude acquisition, which can even jump their debt, I believe, to maybe 2.5 billion. That's a lot of debt, and there could be another reason why the stock has been going down. And the thing is with Crocs, it has pretty good free cash flow, but it has not been very consistent. But as you could see, since 2016, actually, it started only turning positive from negative, and then it was, growing pretty steadily from there. So I'm not really concerned on the debt, but I would personally have preferred if Crocs was paying down the debt instead of, trying to buy back shares to make the EPS go higher. But I think they can do it. I'm not really worried because they have a lot of cash flows. They can cover the debt. They can cover the low interest, which they got on those loans. I believe 2.5 or 3%, which is not high at all. Their long-term guidance wasn't actually bad at all. Around 5 billion for Crocs, 1 billion for Hey Dude, a total of 6 billion in guidance for 2026, and around 20-25% revenue growth in 2022 for Crocs. This is not bad at all. Now, if you look at Wall Street's estimates, they actually expect much more than Crocs is trying to expect, around 6.4 billion in revenue and around 1.2 billion of net income. Now, if you just take that 1.2 billion of net income and then you just time it by a P of 10, which is really not bad at all. If you compare it to other players, this is trading at a P of 10, 22, 20. I think 10 is not really bad for Crocs. So if you just take that number, this is around a $12 billion market cap, and now Crocs is trading at a $4.8 billion market cap. So this is more than a 2x, I believe a little bit close to a 3x on the stock for Crocs. But I'm not gonna do that. I'm gonna be more conservative, of course, as usual. I'm not gonna take the 6 billion. I'm just gonna take 5 billion. So I'm gonna shave off like 17% of the 6 billion. I'm gonna just take the 5 billion. And I'm gonna use their net income margins right now, which is around 19%. And I'm gonna just time it by, 19%. This is around $950 million of net income. If I just time it by a PE of 10, which I think is more than fair, a PE of 10, this is $9.5 billion market cap. What is the market cap right now? It is around 4.8 billion. So I'm just gonna divide that number by 4.8 billion. This is around a 97% upside over the next 5 years, so more than 100% for Crocs. Being very conservative with a PE of 10, it's shaving off 17% of the total market cap. So for me, I think Crocs is a buy, but I'm gonna have to look a little bit deeper to make sure I'm not missing anything, because very few times in my life I've seen the stock like that in the stock market trading at such low valuations with such nice business model, everything like that with good fundamentals. It's very rare, and there's usually something hidden. I'm gonna try to find what it is. If I don't find anything, I'm personally gonna maybe open a position in Crocs, maybe buy just long-term call option and keep it a small percentage of my portfolio, as it's really not bad at all. Although I don't really like this business model, I like more like a repeat kind of business, subscription as a service, stuff like that. But I'm gonna look more into it and then maybe make a decision. So this was my thoughts on Crocs stock. If you liked it, please press like and maybe consider subscribing. I hope to see you another one, and thank you for watching.